So for today's session, the recommendation to move to a fit-for-purpose advice document that prioritises substance over form is undoubtedly positive for financial advisors providing risk advice. Using an interactive case study, this session, Fit for Purpose, Risk Advice Post-QAR, will focus on risk transfer/retention through the lens of risk tolerance, including new risk tolerance questionnaires, and the client's capacity to pay and prioritising their goals. The session will also present a new risk record of advice containing the information which is felt must be included in any record of advice post-QAR. This session has been designed to cater to all levels of risk insurance engagement, from risk specialists to the occasional risk writers, and finally to those advisors who are looking to fall back in love with risk. Our presenters today, Scott Hoger and David Glenn. Scott, a seasonal professional with over 20 years of experience in the industry, serving as the National Manager for Education and Partnership at TAL. And in 2011, Scott co-founded a successful financial planning venture alongside his wife, specialising in personalised insurance solutions for individuals and businesses. Scott later transitioned into a dynamic team, sitting over there, TAL, where he continues his unwavering commitment to providing cutting-edge advice. At TAL, Scott's roles evolves around offering strategic risk advice to financial advisors and licensees, ensuring that they are equipped with the most valuable insights to serve their clients effectively. And with David, who's responsible for providing advice on the tax treatment of TAL products, he also leads the development and delivery of technical content for advisors. With over 20 years' experience providing tax and strategic advice to the financial services industry in Australia and Asia, David is well equipped to work closely with advisors to formulate effective client solutions. David's worked as a tax partner at a large accounting firm and more recently as a tax counsel for several insurance companies. He's a qualified solicitor, CA, and holds postgrad diploma in taxation law. So welcome to the stage, Scott and David.
Thank you. You go first, DJ. Thank you. Good morning, everybody. Great to be here on day 3 after the gala dinner last night. Good to see the room so full, which is great. It's missing a few of our colleagues from TAL, unfortunately, after an incident on the dance floor last night at around midnight. Bit of a knee injury, which he thought was okay by drinking for a further 4 hours. He's now, unfortunately, on the hotel bed, or on the hotel floor, actually, because he can't get up. So that's the funny part of the day. What's unfunny is David's qualifications. So when he speaks, prepare to be, bored, to be fair. All right, so we're going to be talking about fit for process. We've seen presentations from David, from Sarah, from the Minister just recently about the QAR changes. We'd hoped by the time this session came around, we would have, if not legislation, an announcement regarding the statement of advice, but of course we haven't got either, other than it's due to come. So we can't be wrong or right, I suppose, in relation to what we've got for you today. But we're really going to go through the fact that we don't think the removal or the reduction of the SOA is going to be the big silver bullet everybody expects in relation to risk advice, because we're focusing there on the output. What we want to talk about today is really the input, which is what makes up an appropriate recommendation for a client, what needs to go into the process, and what can we make repeatable, what can we make something that we do every time for our clients to reduce the cost to serve for financial advisors. I think Sarah said it best, that if we want to reduce the cost to clients, we have to reduce the cost to create for advisors. And that's kind of what today is about. Now in your apps, you've got access to 2 of our documents for today. One is our brand new, never released risk profiling tool for insurance. And we'll talk about what that means a little bit later. The second is our revised statement of advice, record of advice, whatever you want to call it, which contains the things that we think could be important to be inside of a document post QAR when we do move to this whole idea of substance over form. Disclaimer on the screen, obviously very important information contained in today's presentation is general in nature. We are going to talk about things like corporations law, the code of ethics, obviously QAR. We'll probably throw in a few things around taxation because that's what David will clearly want to do. So that'll be part of that today, all general. Make sure that you look at that in your own time for your own clients. As importantly, the documents that we have not been approved by your licensees. So what's in your app right now, the risk profiling tool and the ROA, SOA, is not something to take and start to use without conversations with your licensees before moving ahead. We think they're good documents, obviously, but it's a really important disclaimer to get out as the beginning. So the only constant is change, and unfortunately, the provision of risk advice, you've seen nothing but change from 20 years ago. You know, when I first started with the old customer advice record. Who used the old customer advice record in the room? Quite a few. How good was that as a document? Front page, back page, commission, that's it. Why does the client need insurance? Because they do. Very compliant. These days, clearly that's not going to work, but we know that we've gone through a lot of change, from commission rates going down to obviously regulatory pressures driven by any number of different reasons in respect to risk advice. And we have focused on regulation, and we focused on making things more foolproof for the consumer, which has, I think it's been acknowledged by everybody around town that it probably hasn't quite worked. What it's done is reduce the ability for advisors to give good risk advice in this space. Remuneration, obviously, was another. Now, you know, wherever you fit in terms of this whole concept of remuneration and where you think it might be, at the moment, we could probably all say it's not high enough to justify in terms of the cost it takes to put a client on the book. So remuneration is clearly one. And lastly, professional standards. Did anybody here in the room actually attend the TAL FASIA Masterclass in the room? Did anybody go? We've got quite a few in the room. Hopefully that helped your journey in getting through the FASIA exam. We had 11,000 advisors go through this. And you know, that's one of the things that we think is really important for a product manufacturer to do, is to make sure that we can help advisors with change like that. But we've seen professional standards obviously change, and we have seen obviously just recently the professional pathways, or the experience pathways, being passed, which I think is really good news. So the only constant is change. We've gone through this whole process of regulation, remuneration, professional standards, but it's compliance, I think, that's really driving the way we do risk advice today, rather than the outcome for the consumer. I mean, we still see some licensees go down the path of saying, if the client needs the cover but can't afford it, you must still recommend it. Now, to me, that doesn't make a great deal of sense, because if you look at the way corporations law is written, you need to give clients advice that is in their best interest, but also appropriate to their needs. Now, giving the client a policy they can't possibly afford, how can that meet the appropriateness test? So we've seen that drive advice. We've seen, unfortunately, a few big cases blow up in relation to the courts, where if I make a bold statement and say clients do not take responsibility for their own financial actions, would that be pretty fair? Unless they're good, who's got a friend with a good crypto result? So when it's crypto, they're happy to spruik, but other decisions that they make which could result in detriment, they don't take responsibility for, which leaves, obviously, the advisor open for potential conflict in the future. So we know that that's the reason licensees are concerned. And as mentioned by Stephen Jones this morning, a post-QAR world that doesn't have everybody's input is not going to work. If the statement of advice is removed, or the need to give that written documentation in the form it is today and replaced with something else, what's to stop the licensee or the PI insurer saying, well, that's all well and good, but we need something more concrete. We need something a bit bigger than what you've got there. So the focus has got to be really on what the inputs are going to be. We saw, obviously, the underinsurance problem in Australia is pretty significant, which we'll get to in just a second. But only 6,300 advisors wrote a single risk policy in the first half of 2023. And you can see the stat that fewer than 500 advisors are responsible for 50% of all the new business. And it's for all the reasons that we've been hearing across our roadshows over the past 6 months as to why people aren't writing risk anymore. Does anybody want to shout one out as to why they're not writing risk? And this is the interactive part of the day. You don't have to, James.
The process of writing it, including the underwriting process, has become more and more onerous, certainly more than what it was 42 years ago.
Well, I'd agree with that. I mean, there's probably 6 questions 42 years ago in the underwriting process. Have you died? No, you're in. So I accept that underwriting's become more difficult, but I suppose so has Australians' health profiles. And so is our risk tolerance, to be fair. In days when you started 42 years ago, and even when I started 20 years ago, clients weren't claiming because they weren't going to the doctor. These days, our friend Matt is clearly going to be at the doctor very soon for his knee, but Australians are seeing more doctors, which results in more diagnosis, which results in more claims. So there are more complex things at play in relation to the way we underwrite policies. There was one over here as well.
If you're presenting a premium for $15,000 and it's like, or $12,000 and 15% of their income, we are saying that you can find out if you've got family. We've always said that, that will support you. So they are actually going to their parents and saying, if I have a claim, will you support me? And obviously only in wealthy situations where you know that's the case, but we're finding people are electing to have family support rather than pay the premiums just because they're getting unaffordable. If they were back in the $3,000 or $4,000, everyone will donate that amount of money, but as soon as you get up to the point where it's very expensive, people are electing. And obviously we all know that most people are not even asking that question, they're just relying on go help me or go fund me or whatever it happens to be.
Thank you. So I'll surmise that by saying cost. 20 years ago, insurance was cheap comparatively compared to what it is today. So when you were looking at product recommendations, you'd tick every single box because back then, the price was great. The price is not the same as it was 20 years ago, and that's driven, as we mentioned, by any number of different factors. So the clients are going to have to make trade-offs, and they're hard to make because insurance policies are something your clients absolutely want. Why wouldn't they want to protect their families? But they have to balance that against their ability to pay. And so that's what we're going to talk about today as part of our process, is to go through this whole idea of the trade-off well and truly as part of the process rather than the end component, and we'll show you how we do it through a few tools. Australia is uninsured. Stephen Jones focused on retirement today in his presentation this morning. Absolutely, very important. We need to make sure that we have enough financial advisors to provide retirement advice. But if we don't do something fast in the risk space, there'll be no one to give risk advice. And there's a lot of consumers out there right now who absolutely want risk advice from financial advisors, but we don't have enough financial advisors to do it, and the cost to serve is too high. The research that we've done in the Academy tells us that advisors are spending around 20 hours per client file to get them on the books. Would that be fair for everybody in the room? That is significant. From start to finish, 20 hours. And that's too long, obviously. And if we go back to the old customer advice record, where I think it would take 5 hours at most, and that's if you were good at compliance, which I probably wasn't, 5 hours compared to 20 these days. So we understand that this is the bit that we have to focus on to make sure that we can get more consumers through the door. Deloitte's Mind the Gap report indicated that Australians could have claimed $25 billion more last year had they not been underinsured. And so this is the bit that the industry, or the part the industry needs to play in terms of providing that community service, which is making sure that we get clients in front of financial advisors to give good financial advice. The stat here is, again, from that report talking about Australians being underinsured by 60 to 80%. And I look at my own scenario as I make decisions around my own cover. I'm clearly underinsured myself. But I have to make a decision, like every one of your clients, around what am I prepared to pull out of my pocket and give to the insurance company for an event that's not certain. If you think about insurance, what is the likely chance of you claiming on a policy? What do we think, just generally speaking, across all 4 products? So if there's a 100% chance of claiming, what do you think the actual claim rate is at an insurance company? It's not 10%. If it was 10%, the premiums would be a little bit higher than they are today. So lower than 10, we've got 2 there, 2 to 3%. The biggest claimer being an annuity style product called income protection, but less than 3% chance of claiming on a policy. So consumers, educated consumers, need to make a decision. Do I run the gauntlet and hopefully win, or do I take out cover, or do I talk to a financial advisor and get this middle ground solution that suits my circumstances? Get personal advice to give me the outcome I'm after. Because financial advisors give good advice, because your advice is all encompassing. The client probably doesn't care much about the product, they care about what it does, but all the peripherals that you do give advice on in relation to risk products. So what's an example of a financial advice discipline that you give advice to your clients about when they seek life insurance? So what are you talking about to your clients? What type of subject matter? Death is an important subject matter, but probably not what I was leaning for here. You will be talking about life and death, obviously, but you're talking about things they don't expect you to talk about. What about estate planning? Where does your money end up? Now at TAL, unfortunately, less than 10% of our claimants with life insurance policies have a nominated beneficiary at time of claim. These are advised clients. So where does the money end up? In super, who makes the call? Trustee. When it's non-super, what happens? The estate. And what do we need as an insurance company before we pay the estate? Probate. Yeah, so it takes time to get the job done. Remember, non-superannuation beneficiary nominations are also indefinite nominations, which means that if I have my ex-partner as the nominated beneficiary, who gets the cash? The ex-partner. So you're giving estate planning advice even though the client hasn't asked you for estate planning advice. What about taxation? If a client pays a premium for a life insurance policy out of their back pocket, is that tax deductible? No. But what if a trustee does? A trustee of a superannuation fund? Yes. It's a good start. What if the client pays their premium via a personal contribution to superannuation? For the purposes of paying a life policy, do they get a tax deduction if they're under their cap? Yes. So now you get a tax deductible policy from the payment from the client and at the level of the trustee. Is that better than not having a tax deduction? Now, clients don't expect that. That's the power of the advice that you give. Cash flow advice, tax advice, superannuation advice, all this advice comes as part of the services that you provide. So going to you makes perfect sense because they're going to get the outcomes that they want. And then there was light when QAR first came out. David did a dance, which wasn't ideal, but he did. And he was very impressed with the engagement from government in respect to ensuring that we're going to get the outcome we're after. But I think one thing that was missed and an opportunity that we could have had that probably hasn't eventuated so far was nobody spoke about risk, and no one ever does. And so when we talk about things like SOAs and the reduction and the changes, nobody ever thought about this specialisation called insurance. And so what we wanted to do through the Academy and what we're going to show you today is, well, we want to shine the light on insurance because it's different. It's not the same as giving superannuation advice. It's not the same as giving retirement advice. There are different aspects at play that we think need to be explained and shown to the client, and that's what we intend to do. You know, QAR was to improve access, affordability, quality financial advice, but we are yet to probably get some of these big ticket items across the line just yet. The 5 changes that we saw previously, they're okay. That's a pretty good start. There are still things that need to be worked through, but the big ones around statements of advice and safe harbour, although I used to quite like safe harbour is still yet to come. So hopefully we'll see that pretty soon. So what we're going to look at in terms of this presentation today, as I said, is we're going to focus on the aspects of risk advice that we think are really important for the consumer. What we want to do is give you a repeatable process that you can use in your own practice that focuses on the things that we think are going to be most powerful for your first engagement with the client, but all future engagement as well, because insurance is one of those policies that should hopefully go down over time with advice. We want to talk about how we might do that through today. So fit for process, we know that this requirement is not up for debate, but what is included in the document is. So we've done 6 sessions, I think, across the country already talking about what we think should be part of an SOA, and we've got lots of experienced advisors attending these sessions. They've all got their own view as to what needs to be part of this document. Whatever the outcome is and whatever your own preference is, we think these discussion points we give you today should, if not form part of the document that you give to the client, it should form part of the process. Because insurance is different than it ever has been, and it requires you as the financial advisor to really get your hands dirty in terms of the big ticket items that the client needs to be talking about, which is risk versus cost, because that's what everything comes down to at the end of the day. Every purchase decision your client makes comes down to one thing. Is it worth the money? Because if it's not, they won't buy it. It's why people buy Teslas over Toyotas. It's why people wear Prada over Target. These are the reasons that we make decisions. It's based on our own perception of value. And it's also based on your client's current financial position, which is something that David and I will talk about throughout today's presentation. So we'll focus on the inputs that we think should be part of risk advice to give you, and this is the headline, a streamlined, compliant, repeatable process. And our challenge was from both our employers and the FAAA was to make you fall in love with risk again. Risk is a hard thing to love, but hopefully you'll at least like it moving forward. All right, agenda for today. We're going to go through risk identification and quantification, really focusing on the fact that when you identify risk, that risk is going to be ever present for the client no matter how they deal with it. Because a lot of clients who don't make decisions around insurance do nothing, and that is a decision. Their decision is they know the risk exists, but they're going to walk away because maybe they don't understand or because they've taken a position that they don't need to. David will go through quantification as well really quickly. We're going to focus on a few technical aspects of quantification that I think is quite important, particularly around ownership, when you hold policies inside of superannuation. We'll then go through establishing goals and objectives, not so much the basics of this, but we're going to talk about prioritisation. Because if I think back to when I first started, really the only thing that we used to talk about on the insurance was protecting the client's debt. And in today's world, your clients probably haven't shifted their mind too much around what they want from a financial advisor. When they first come and see you, is their expectation that debt is repaid? Probably. The extra stuff that we talk about needs to be obviously discussed afterwards, but I think prioritisation is a really important part. We'll then go through risk transfer and retention, and what David will go through here is the fact that you can't remove a risk, you just got to deal with it in whatever way you see possible. We'll give you a few examples of this. And lastly, we'll go through outcome mapping. And outcome mapping is designed to allow you as a financial advisor to be able to look at whatever you're doing and determine, is this good for the client from a tax perspective? Does this meet all regulatory requirements? And are there any legal considerations that we need to be aware of in relation to this strategy? The power of the mapping, which you'll see a little bit later, is that you can do this with your client on an annual basis. And what you'll find is situations where the strategy that you previously had is no longer going to work anymore. A quick example before we move on to David is, let's say your client is, a child of your client is 16 years of age. Are they a CIS dependent? Yeah. Are they a tax dependent? Yes. So we can pay a death benefit to this child through superannuation, can we not? In lump sum form or pension. If it's in lump sum form, who gets the cash? The child's 16, not a legal adult, they're a minor. So who gets the cash? Usually it will go through to the guardian. Who went to Adam Crabb's session yesterday? All right, so he had some depressing stats on those slides. The first depressing stat that I saw was the average time from marriage to separation is 8.4 years. So those of you at the 8.4 years right now, good luck. I'm 10 years, so I should be okay. The average time from marriage to divorce is 12.2 years, which is a big separation if you ask me, but 12.2 years. So a lot of the clients that you'll sit in front of, have they had previous partners? Have they been divorced? Generally speaking, do they want their ex-partner looking after cash of theirs? No. We give money to the child, what happens, DG?
It goes to the ex-partner.
Which is not...
In her capacity as guardian.
It's not a great result.
He controls the funds. Absolutely.
Now, do you think Canberra's got a department sitting there somewhere that looks at control of this money and where it's gone? Sorry, it's got to be for the benefit of the kid, but you went and spent money at the coffee club, which I don't suggest you do. No, they don't. So when does the kid find out they haven't got their inheritance? At age 18, yeah. That's an example where things can go wrong, but I wanted to bring this up from the regulatory side of things because when that child turns 18, something shifts. And what shifts is that they are a CIS dependent, but the question's going to be asked, are they a tax dependent? If they are not a tax dependent, what happens? Taxable. So overnight, the client ages one day and all of a sudden we expose ourselves to regulatory risks around taxation. This is where the mapping can really draw out these benefits that we can give as financial advisors to help our clients out through the process. So that's what we'll talk about at the very end, should we have time. I'll hand you over to David right now, who's going to go through the next part of today's presentation. You don't need to clap. You don't need to clap because I'll be back.
Right, so what we've got here is a challenge that we've got to have a fit-for-purpose SOA and an underlying process that is streamlined and cost-effective. That's basically the challenge that we've got. So what I'm going to take you through is a suggested approach to try and work towards that particular end. So what should our approach be? I think our approach firstly needs to be risk-based as opposed to product-based. And that's quite a shift in mindset for our particular industry, because we traditionally have been focused on product and not in terms of risk. So the first thing we need to do is we need to consider the client's risk profile. Now, what does that mean? Well, what it means is we've got to get a complete picture of what I call the client's points of vulnerability. You've got to ask yourself, where is this client vulnerable in terms of their domestic situation, in terms of their business situation, and in terms of their superannuation situation? Those are the three broad categories that you need to consider in terms of identifying the client's risk. So what we've developed here is a risk matrix, which is in essence is a 2-page document sitting within the SOA that kind of encapsulates this particular risk profile. So that's our starting off point. Get those points of vulnerability underneath our belts. The next thing we've got to do, once we've identified those points of vulnerability, is to quantify the loss that is represented by those points of vulnerability materializing. And the loss is what the loss is. The loss does not change, because the client is exposed to that loss. And that is a very important fact. We must not compromise on that loss amount. And a good example where an advisor did compromise on that amount was in the Revesi case. What the advisor did in the Revesi case is did an SOA recommending an insurance amount for the client, and the client was a typical client in that situation, and the client said, I can't afford the cover. What the advisor then did is got himself into a Dutch auction situation, which is how much cover can you actually afford? And they then settled on a lower amount of cover. The client went on claim a few months later in the Revesi situation and found he was underinsured. And clients, as Scott said, don't take responsibility. So the client sued the advisor. But very importantly, the federal court in the Revesi case upheld the client's position, because the advisor had failed to alert the client as to the consequences of taking a lower amount of cover. The risk is what the risk is. The client responds to that risk by either transferring that risk to an insurer, or alternatively, the client will self-insure. And there's nothing wrong with self-insurance, provided that it's done from a point of view of knowledge. So getting back to this fit-for-purpose SOA that we're developing, we try and encapsulate the risk of the client, the quantification, and the client's response to that quantified risk in a single page within the SOA, because that encapsulates the risk and encapsulates the advice. And very importantly, what I think the advice needs to concentrate on going forward is not only what is covered by the insurance amount, but what is not covered. And clients need to understand what is not covered. And very importantly, what are they going to do when that uncovered risk materializes? So the matrix needs to specify what is covered and also what is not covered. And then we will note on the matrix, in regard to the uncovered risk, what is the client going to do about it? And if the client has got no resources whatsoever and is going to have to default to Social Security or a GoFundMe page, that needs to be noted on needs to be noted on the matrix. Because remember what Standard 5 requires of you. Standard 5 requires the client free, prior, and informed consent. So the client needs to understand what is not covered. And inevitably, when you get a complaint regarding advice, in most instances, it deals with what's not covered. The client has received advice, and for whatever reason, the advice does not meet the client's expectation. So we've got to make sure that when we go forward in our fit-for-purpose SOA, whatever format that takes, that we meet the client's expectations, and the client then needs to make an informed consent. Now, when we come to insurance, of course, the client's going to want comprehensive cover. Who wouldn't? But the lens is quite different when we start talking about cost. And of course, that is going to be driven by the client's approach to risk and the client's attitude to risk, which is why we've got to start looking at the client's goals, the client's priorities, and the client's attitude to risk.
Just quickly, David, before we move on, I think practically, if we go back to the previous slide on quantification,
Yeah.
a couple of things that we're seeing, just so you're aware in the industry right now from compliance and those sorts of things, is obviously when we're dealing with cover, we're dealing with net amounts. So you put something in your SOA that says $1 million, well, the expectation from the client is, well, that's net of tax. TPD is one of those things that's quite difficult to deal with in superannuation because you need 3 dates and you only know 2 of them. So if you think about the dates you need eligible service period, you need age 65 retirement date, but what's the other date that you need? And if you do get it right, we do have this prize for you today, which is a towel cup. These are very rare, I believe. There's not many around. So what's the other date that we need to make sure we get this calculation right? Date of claim. And so you get this cup, which is great. Please come and get it. We need to get rid of them. Date of claim, which you'll never know, which means whatever you put into your recommendation is going to have to be an estimate, because I don't think many of you are going to want to insure at the highest tax amount because your chance of claim is low. That's a huge amount of premium to have to then fund for that client for the life of that policy. So I think in your documentation, you're going to have to use terms like best estimate. And what we are seeing, again, as a bit of another industry trend, is sums insured are not going up anymore. They're starting to come down as we look at reducing the amount of cover that we look as part of our calculators to account for other things. For example, your income protection offsetting your TPD amounts. You don't need both. And so I think really importantly, when you do quantification methodologies, whatever you use, you need to have in your head, how are you going to be able to explain this to the consumer? Because if you do walk away with less than what it says in your SOA, you're going to have that proof point under Standard 5, as David mentioned, that you or have the belief that the client understands the advice that you give and you have reasonable grounds to conclude that. So think about your TPD structures. If you want a calculator, please feel free to reach out to the TAL reps at the stand or your TAL BDM.
Very important issue about risk quantification is to make sure that the amount is calculated in a transparent way. And that's why we're passionate about the risk matrix, because what the risk matrix does is it segments the risk into its components and deals with each component separately. So it'll deal with debt risk separately, it'll deal with residual cash flow risk separately, and what that enables the advisor to do with the client is, in conjunction with the client, decide which risks should be transferred and which risks should be retained. So we're moving away from the situation where, as an industry, we've tended to be a bit too opaque in terms of our quantification of risk. We've always thought about, we said to the client, you need $1 million or you need $2 million, whatever the number is. Now it's becoming much more granular, much more transparent, and I think that is the way we're going to move forward as an industry. Now, it's all very well to quantify risk, and the client's then got to respond to that. But we've got to establish what the goals and objectives of the client are first. Because the goals and objectives are going to drive the client's response to risk. The client's decision in regard to the risk is going to be to transfer the risk or to retain the risk. And that is going to be driven by the client's attitude to risk, and attitude to risk hangs off the client's goals. So our fit for purpose SOA going forward, in my view, needs to cover what the client's objectives and goals are. Now, when we get to goals and objectives, we're into a very interesting situation in terms of working out this whole question of appetite to risk. So over to you, Scotty, to talk about this one.
All right, so for those that do holistic advice, you're all very familiar with risk tolerance questionnaires, which make perfect sense to me. What you're trying to establish here is your goal for the client and their risk tolerance. And what you're trying to find out, is there an incompatibility? Now, if the client has a low risk tolerance but a high goal, what do you have to do? You're going to reduce your goal, or you're going to increase risk. That's the only way they're going to achieve their outcome. Now, with insurance, we had to think about this, and well, unfortunately, all clients want whatever you've got, because you'll ask the question like, is it important for you to have an amount to pay out your debt? The client will say, yes. Is it important to have an income stream payable to your spouse in case you're dead? The client will say, do you want your kids to go to private? I mean, do I have to keep going? They're going to say yes for everything. So that's going to build up this whole idea of cost and need. But what they are constrained with is their capacity to pay. And that's the problem your clients are facing right now: cost of living crisis, insurance premiums going up, interest rates. It's a perfect storm, unfortunately, where your clients probably aren't questioning the value of their cover, they're questioning the amount. And they're probably questioning that premium side of things. So what is their risk tolerance first? What is their capacity to pay? If their capacity to pay is low, what happens to their risk? It goes up. The less insurance your client takes, the more risk they're going to have to take on themselves. But nobody has that in documentation. And when David talked about NAB versus Revisi, clients, recommended $2 million, takes out $1 million based on cost. That happens every day of the week. And the client says, well, I didn't have enough at claim time, and that's your fault. Well, how can that possibly be right? Because the process that we undertook didn't quite allow the client to understand their risk. So we look at this insurance appetite and affordability, and you think to yourselves, well, where would my client sit in relation to this if they were informed? Now, we know, and I've told you today, that less than 3% of clients claim on their policy, so you can probably be, in a lot of cases, balanced or conservative, or it's comfortable, and you'd run the gauntlet and you'd win. You'd take out no cover, you'd never claim, you'd have all the money in your bank account. But we know that we're protecting against these worst case outcomes, right? So most clients are not going to be probably risk comfortable, but how they deal with this risk is going to be really important, and how you substantiate that in your documentation is just as important. Now, if you think about what David spoke about, NAB versus Revisi, I want you to think about the practical applications of how that would work in practice. Client comes in, says, you say you need $2 million. Client goes, can't afford it. What's your next step? The client can't afford $2 million. Now, what I have seen, and certainly what I used to do back in the day, can't afford $2 million. What about 1.8? Can I get 1.6? Can I get 1.4? What about 1.2? You want one? Sold at $1 million. And the way I'm going to demonstrate how we got there is through my authority to proceed, which conveniently has 3 lines. And those 3 lines will say, client has taken out $1 million based on what? Cost. Does it say how we got to $1 million? No, it's just a number. Wasn't it 1.2? Wasn't it 1.3? Where are the calculations to demonstrate? Cost is a very big variable though. The client got to it, but you're the advisor. So what we're going to talk about here is how would you get back to a relevant sum insured that links back to goals and objectives. Now we're going to use risk tolerance as one, and that's going to demonstrate to the client, hey, you know what? This is where you sat on this risk tolerance. You've agreed to accept a level of risk, but the risk matrix will show us then exactly how we are going to get to a relevant sum insured without playing this price game. Because the last thing I think anybody wants to see is authority to proceed with 3 lines with no idea how we got there. Now, David, if you open your apps now, if you want to open your apps now, I think one of the TAL person's internet shopping over there, change the apps to the actual conference app. You'll see our risk tolerance questionnaire in there that David's created. Now, this is one of 2 risk tolerance documents that are available on the marketplace right now from insurers, but I would expect to see universities get involved in risk tolerance in a more meaningful way coming, or hopefully quite soon. So it's available there, as you can see on your app. David's put together 10 questions. David, in 2 minutes, can you just explain how you put that together?
We've got to put the client in a practical way on that matrix over there. So the important point is that we need a set of questions that give us a starting off point in that discussion with the client. So if you look at our risk tolerance questionnaire, and there's nothing, I say, revolutionary about a risk tolerance questionnaire. Our colleagues on the investment side have been doing this for years. We now need to adopt this approach, in my view, on the insurance side. But practically, where do you actually put the client on that matrix there? And the questionnaire will help you put the client in the right spot on that matrix. And all the questionnaire does is it stimulates that discussion and gives you an indication of the client's position. And you do not pigeonhole the client. That's the important issue. Say, client, based on your responses, we think you're a conservative sort of guy. And the client then might say, no, that's not me. I'm more gung-ho sort of individual. That's fine. The questionnaire is not some sort of, it's not some ultimate diagnostic tool. It's there to help you stimulate that discussion. So what have we done in this questionnaire? Well, we've decided to distill this down to 10 key questions as far as risk is concerned. The last thing you want is a 100-page checklist. That's defeating the purpose of the exercise. What you want here is something that is going to distill the key essence of the risk. So what we focused on those particular questions is in regard to assuming death or disability happens, how long have you got in terms of a family in order to survive? We also asked them the question in regard to their attitude to other forms of insurance, because that's a key indicator of risk. Does the client have health insurance? Does the client have general insurance? Motor vehicle insurance, comprehensive motor vehicle insurance, or do they just drive in the hope that they're not going to smash into anybody or anything? And that will be a very good indicator, in my view, of where the client is going to be put on that risk matrix. We have to get the client into that risk matrix without pigeonholing the client. We then know what the client's risk tolerance is going to be. Clients with higher levels of risk tolerance will want more comprehensive cover than their counterparts, and that is why this exercise is extremely important.
And you don't need to use the scoring system. I mean, half the questions are the questions you ask anyway as part of your normal process as a financial advisor, but what you're trying to do here is demonstrate in a document that you have had these questions with the client. So if things do unfortunately go wrong and you do get to a sum insured that is far from optimal because of cost, and the client says, well, how could this possibly have happened? You've got documentation or proof points that sit behind it to say, well, hold on, we've gone through these questions, we've gone through cost versus risk, and this is where we ended up. It's to help the client make these choices and decisions in terms of risk that allow you, the financial advisor, to be comfortable that if anybody asks any questions as to why you did what you did, you've got proof that sits behind the scenes. So use the questions, don't use the questions, use the scoring, don't use the scoring, but use something to get you on this risk tolerance, to give you another proof point in your documentation as to why you ended up at the spot you ended up with.
Now, getting back to the client's goals, you've put the client on the risk matrix after appropriate discussions with the client. You've then established the client's goals as well. what's the next step in that particular process? Well, we've got to look at those goals. The client's goals are going to be blue sky goals. We want to do anything and everything. I want to live in the best suburb in the city. Of course, everyone wants to live in the best suburb in the city. And I want to retire with $3 million or $5 million, whatever, at age 50. Well, those are legitimate goals, but the question is, the client will not be able to achieve those goals because the client doesn't have the resources in most instances. So what really comes out of this is we've got to help the client prioritize, because the client's going to have to make certain calls. And that links back to what Scott was talking about earlier on about trade-offs. Insurance choice involves a trade-off. You are trading off as a client the cost of more comprehensive cover for less comprehensive cover, and taking the savings and using them for some other purpose. So you're determining your priorities. Alternatively, you have to take comprehensive cover, and the trade-off there is you then have got less cash for investment, less cash for cost of living. So either way, it's a trade-off situation, and our position as advisors is we need to help the client make those particular choices. A good example here is an income protection contract. We need to say to the client, for example, in an income protection contract, client, you want an age 65 benefit because you are risk averse, so you want to make sure you're covered for the rest of your working life. That's got a cost attached to it. More than 50% of your premium is going to be to secure the age 65 benefit. The client needs to understand that they, as risk-averse individuals, are actually paying for that. And the client might decide, no, I'll take a 5-year benefit period because I want to save that cash to utilize and put against my mortgage. It's a question of client's priorities, and the client's priorities are driven by the client's attitude towards risk. And that is why in our Fit for Purpose SOA, we need to go through these particular exercises. And that then takes us on to our goals matrix here. In terms of the goals matrix, we need to articulate the client's goals, which we've done there, and then the key is what you'll see in the second last column there is what are the priorities. And different clients will have different priorities. Over to you, Scotty.
Look, I think the benefit to this is that you're going to have to, I think in most cases at least, get to a relevant sum insured that's not optimal. Because the client's going to look at the premium and say, we can't afford that. Now, there is a small percentage of clients that see what you put on paper and say, I can afford that, I will pay that premium. But the bulk, the mums and dads say, look, we have to get to something we're all comfortable with here, because the last thing we want is a premium to be on the books for 12 months and then drop off. So you're going to have to work out how to get to a relevant sum insured. We've gone through the auction method, down from 2 million down to 1 million. This priority goals or prioritisation checklist here or matrix allows you to say, well, look, what's most important to you at the end of the day? Now, it's funny when you talk to a client how much things like education funding is so important as a discussion point during the fact find, but when they see the cost attached to it, how much they say, well, you know what, our local schools are actually pretty good. Because they see the cost and say, well, there's got to be a trade-off here. And this is where you can start to remove getting into we're running out of time here, so the risk matrix here, where we start to put things on paper to get back to relevant sum insured. I'll give you an example. Like, I look at my scenario, I'm 41. Next year's my year of health, my wife has told me. So I'm 41, she's 38, we've got 2 kids, 5 and 7. My wife doesn't work, she looks after the kids. So I'm the primary income producer. And we say, okay, well, let's put together a recommendation with a financial advisor. What would they come up with? Well, they'd say, okay, well, you want to repay your debt, that makes perfect sense. What about an amount to fund an income stream to your spouse in the event of your death? Education costs, child maintenance costs, all the things that you would expect to see in a recommendation. And then we see the cost. And we say, okay, well, that's pretty expensive. Are there other ways to achieve the outcomes that we're after without putting our hands in the pocket to pay the insurer? Let's look at the income stream part of it really quickly. What else can my family do that doesn't involve putting my hand in my pocket and paying for a life insurance policy to fund an income stream to my spouse? What else can we do that doesn't involve me taking out insurance, but deals with the risk in a different way? She has to go to work. Now, someone usually at this stage would say she gets remarried, but look at this. Would you want to move on? I don't think you probably can. But yes, she has to return to work. Is that a problem? Maybe. Meanwhile, my wife's quite capable. I think she'd be okay going back into employment. Now, that is not a perfect solution. It deals with the risk in another way, but what it does is it takes my recommendation, and don't worry about the numbers on the screen, it takes my recommendation from 2.1 of life cover down to 1.3 based on that one decision. Now, we may have got there anyway through the price game, but now we have a reason to get back to 1.3 that everybody understands it's not perfect. Now, if I die, that's a terrible example, but if I did, my wife has to return to work, who's going to look after the kids? Childcare. So what are we going to have to add into our quantums that we didn't necessarily have before because my wife looks after the kids? Childcare costs. And that's where you can put in things like child maintenance costs, which you can use any different form of information that you can get from the ABS or Care for Kids or wherever you might use to find out, well, what would it cost me to send these kids to childcare after school and before school? Is that number going to be lower than funding my income stream? Yes, far, unless childcare education expenses have gone berserk in the last few years, it's going to be far less. So we deal with the risk in a different way that everybody's on board with. Now, when the client sees the 1.57 as an example, do they know how we got there? If you use that as your authority to proceed, do they know how they've got 1.5 versus 2.1? Yes, it's clear for everybody to see what that answer was. If the client is not comfortable with the amount they walk away with, what can they do? Pay more. And if they don't want to pay more, they're going to have to accept risk. So when you add this matrix into risk tolerance in situations where your clients have affordability concerns, you end up with this position where you've got substantiated advice that everybody's on board with. Standard 5, as David has mentioned, requires this whole idea of the client needs to understand your advice. This didn't exist prior to the Code of Ethics. Like, I'll give you an example. If you go get your car fixed by the mechanic and the mechanic starts to go into this big monologue about what they're going to do to fix it, do you know what I normally do? I switch off. I've got no idea what you're talking about, mate. Fix the car and I'll be happy. Well, I don't want to know how the sausage is made. Financial advice used to be that way. You could give really complex advice and the client would say, thank you for the outcome. The tax saving, the retirement goal, the insurance policy. These days, what do you have to do? The client must understand the advice and you must have reasonable grounds to conclude the client does understand. The reason we put this together was really around Standard 5 was to say, well, how do we get proof on paper that the client gets it? Well, risk tolerance is one. Because if they're not insured for the optimal amount, we've got a risk tolerance document to help us get there. And this shows you how you got to the outcome that you ended up with. Now, this can be used on an annual basis as well, can't it? Because the following year when the client comes in for a review, what can you do? You pull this out. You run the same numbers you would have ordinarily run, and you'll work out, is this still affordable for the client in front of us? If the client turns around and says, you know what, I can't afford this, what do you have to do as the financial advisor? Go through the same process. If you're going to have to give something up, we have to have a discussion around it. That is one of the big things that we're getting through Ask an Expert right now, which is financial advisors saying, if my client reduces their cover, what are the risks? Well, they're pretty substantial if we haven't gone through a process to allow us to determine what the client is going to insure and what the client is not going to insure. So this risk matrix we think can be quite powerful, and as you can see here on the right-hand side of the screen, you've got this retention strategy for whatever your client doesn't insure. I've given you an example for income. my spouse returns to work. My in-laws are also super rich, which is awesome. And so let's just say that I didn't want my wife to have to return to work. What else could I put in that strategy? Family funding, exactly right. So my family's, or her family, as long as I stay married, my family, will be able to fund her income should we need to go down that path, which we wouldn't obviously do, maybe. On the retention side of things, let's look at education costs. You can't afford private school education funding through the insurance premium. What do? Public school. Now, I went to public school, it wasn't that bad. So we can have a situation here where we've dealt with retention in a different way. Let's say my in-laws also live 5 metres away from me, which they used to do, which was, again, very awesome. That's not as positive, by the way. For child maintenance, what could we do? Babysitters. Now, they're going to get to a stage, and they have moved down south now in WA, but where we could have it for free, and in the future, maybe not so much, but we dealt with it in a different way. The retention document deals with how this is going to happen in practice. Everybody's on the same page. Everybody understands. We also do this for income protection as well. David's mentioned one of the main drivers of cost in the last few minutes around age 65 benefits. You know, as a starting point, my view of the world is age 65 makes absolute perfect sense. Now, I've got an old policy dating back to 2003, age 65, agreed value, premier contract, all the bells and whistles. My cost is too expensive now, so I've gone back to a 5-year. If I'm going back to a 5-year, what do I have to do with my TPD? Yeah, put it up. Make sure I have enough to be able to hopefully cover that gap if I ever need to do so. So we do this for IP as well on waiting periods, benefit periods, superannuation benefits. I'm going fast because there's 3 minutes left. Risk retention discussions on the matrix. Obviously, we're going to have all this information contained on the 2 pages. This is a great prompter for your clients when their renewal comes up, where you're sending them information about, hey, renewals happen, let's have a conversation. Because as an advisor, your goal for your client is that they have as little insurance as possible. Would that be fair? Because every dollar they can't spend, or every dollar they spend on insurance, what can't they spend it on? Coffee, the fun things in life, right? Or paying down debt, school fees, that sort of stuff. So you want to make sure that they align their cover with their need. David and I have been talking to a lot of licensees lately where the client is complaining about not claiming. So think about that. Client has a policy, they've got through to 65, and they're unhappy with the result of not claiming on the policy. And what do you think their objection is? They paid the money and got nothing in return, but worse than that, is they put the policy in super when they were 40. As a 40-year-old, $1 million of life cover is probably not that expensive. But what age does it really start to ramp up? What do you reckon? 50? 51, 52, and all of a sudden it starts to ramp up slowly but surely. What happens to indexation at the same time? Policy sum insured's going up at a time when the client's probably reducing or having a reducing need. They get to age 65 and say, this can't possibly be my fault, but I've now spent $145,000 of my money in superannuation. And not only has it eroded the retirement balance from the premiums, what else has it done? It's reduced the balance on the earnings the client would have been eligible for on those premiums. This document doesn't allow them to get in that position. They can't say they're not informed. You've got it here. It's a document that they can see. If the need has been removed, if they've repaid that debt, what will they tell you when they see that form? I don't have debt anymore. So what will you do with the sum insured? You'll change it. So we think that this will allow you to have better conversations long-term with the client. We're towards the end now. We've got one more slide here that we thought was quite powerful. David, if you want to go through mapping in 53 seconds.
Yeah, sure. Mapping is looking at the outcome as well as the funding. So you do 2 maps. One is the funding, one is the outcome. Because remember, as far as outcome is concerned, you want to be delivering on what I call the golden rule of insurance, which is paying the right amount to the right person at the right time in the right form. So you need to understand all the entities that are involved in the flow. And then once you've identified the entities and the cash flows involved in that particular situation, you then look at each cash flow from a 3-fold point of view. Tax risk, regulatory risk, and legal risk. to ensure that the strategy that we've put in place, when the rubber hits the road and a claim is made under the policy, it's delivering an outcome to the client in accordance with the client's expectations. So that's just an example here of that case study. The money flows through to the spouse on death, and the spouse takes a lump sum sufficient to repay debt, and the balance is then kept within the superannuation system and paid to the spouse as a pension.
The other point to note about this is that, again, when you're going through this process, and this is a real life story as one of the last things we say because lunch is coming, you can map where the money ends up without the client being in the room, right? So whose CRM right now can tell them who are the nominated beneficiaries of the client's superannuation entitlements or insurance policy? So we've got a few in the room, which is awesome. So one of the things that we're sort of advocating right now is obviously the estate planning aspect of life insurance advice. We had a scenario where the client sent back their own binding nomination to the insurer, which was us, it was TAL. And the name was like John Smith, and it was 100%. And so the person who was getting that nomination at the insurer goes, okay, that's great, we'll put it on the file. Client passes away. John Smith wasn't actually a person. Anybody guess what John Smith was? A cat. A cat named John Smith. I mean, come on. John Smith the cat. Now, can you pay cats in superannuation? This is the technical part of the day. And there's a prize of a coffee cup if you get it right. Please. Yes, James? The cat, well, it probably was, if that's who you're nominating for your superannuation. There's a codependency there I don't want to talk about. Now, if you had done the map with the client and put John Smith the cat, you would have found out straight away that that wasn't going to work, and you're able to determine where this regulatory risk will exist for you. Now, what I'm suggesting that you do is, over time with your client base, look at your CRM, run the map on the way the client pays their premium and the way they receive their benefit, and determine, does this make sense? My last example is, 10 years ago, life insurance was written ordinary policies, wasn't it? Superannuation wasn't written 10 years ago because that was the group insurance cover. Now, all life insurance really is written through super for some really good reasons. Clients shown capacity to pay the premiums because it comes from their back pocket when it's ordinary, correct? Client comes in and says, can't afford the premium. What we get at TAL is we get this notification from the client to reduce their sum insured. But what could we do differently using the map to give the client a better outcome that wouldn't result in them reducing any cover? Put in super. They've already got capacity to pay. What if the client's on the highest marginal tax rate? What have we done to their insurance premium? We've halved it. Client maintains cover at half the cost. And this is the power of the map, because you can show them how they do that. Remember, the government does not distinguish the difference between the cost or a contribution for superannuation premium, of superannuation contributions for retirement, and an insurance premium. And let's hope they never do. Thank you for your time. You've been a great audience. I think there's Q&A, maybe. I don't know.
Thank you, Scott and David. I mean, I thought that was a really good framework to have the discussion with the client, so always good to have that. And maybe not a question, but a comment from me, Scott, based on the suit that you were, I think that's more Prada than Target, based on all the things that you said about yourself. So we'll take questions from the floor, actually, as we move on. We've got another, 10 minutes before lunch.
This is either a really good or bad thing. I just can't tell yet. Yes?
Probably more general question than anything else. How do we download the documents from the resource sector on a phone? They just appear and there's no obvious mechanism to get them.
David, that's your area of expertise. Do you want to answer that one? No, we have no idea. But if you are interested in the documents, please feel free to come by the stand, grab a coffee cup, and we'll get your email address and we'll send it through to you.
Fantastic. And just a final comment, you've managed to make risk somewhat interesting for a presentation, so well done to both of you.
Thank you.
Look, all the resourcing and the slides will also be on FAAA Learn in the next couple of weeks when they come out. So, the risk tolerance template and the SOA template that Scott and David was talking about will also be there. So, yeah, over there. Might have to shout.
for that?
They're more approaching us, to be fair, which is good. That's really good news because obviously it's getting out there. But we intend to have discussions with all licensees around this. The thing is, David's a lawyer and an accountant, but he's not a behavioural finance expert. So I think that's the problem we've got right now. But I think there are some groups that have already approved, and we hope to have more along the way. So, but if you want them to approve it, talk to them.
Yeah. I've seen some bad behaviour in my time, so it comes from a practical base of knowledge.
Yes, mate. Yep. Can we just stop this guy from asking the question, please?
No. On a serious note, have seen this done before, and it's in line with the previous lady's question, that some of us still remember ASIC's guidance and regulation risk insurance SOA,
RG90,
which was absolutely brutal. And so are you going to ASIC with your SOA to get your guidance, or are you using your own gut feel on what the SOA should look like?
It's gut feel on the basis that I don't think ASIC will talk to us as a starting point. I mean, we managed to get in front of FASIA, which I thought was interesting. We didn't achieve much, to be fair, but we got there. We want you as a collective, if you like it, to go to your licensees and get them to push this, because our fear, as I mentioned at the start, was if we don't, there won't be a risk-only SOA. It'll be caught up in whatever else gets put in play by government. So we just want you to think about what do you like, what don't you like, come tell us and we'll advocate, but you advocate as well with your licensees.
I think the reality is we're going to be moving into the second tranche of legislation for QAR, which the Minister spoke about earlier today. And ASIC will have to, in my view, revise RG90 in the light of that, that legislation. And hopefully they'll be consulting with bodies like the FAAA in that process, and we'd love to be obviously involved in that consultation process.
The other point too is that part of the QAR is to move to substance over form. I think what's going to happen is there'll be some mandatory requirements that the government will legislate, but the balance will be up to the individual, which means if you think it's important and your client should see it, you should be able to put it in.
You mentioned something about contribution, which the government doesn't distinguish.
Yep.
Towards the end, can you just elaborate more on that?
So if you are under your concessional cap and you make a contribution to superannuation, we treat that as it first comes in as a non-concessional contribution, and then you'll need to fill out the NOI to turn that into a concessional contribution. And when it goes into something like TAL Super, for example, TAL Super is an insurance-only superannuation fund. We don't hold a balance, we don't hold any contributions in the fund, so to speak. But the government doesn't say, well, that's not really a contribution for retirement purposes, so no deduction. They just say it's going into superannuation, you're below your cap, you filled out your form, you get a tax deduction for it. So it's hugely powerful for clients with risk because, your starting point for superannuation is that it's deductible. And then you add in the contribution you make to pay the premium being deductible, it makes it really, really good.
Subject to a very important qualification, bear in mind that the caps work on an aggregate basis. So we've had instances where the investment advice is done by advisor A and the insurance advice is done by advisor B, and advisor A and advisor B are not talking to each other, and we're getting inadvertent breaches of caps as a result of that because the client is utilising the cap fully for contributions on the investment side. And that dialogue, I think, is essential. Again, advice needs to be, we need to always ask ourselves that question, are we delivering advice in accordance with the client's expectations? And the client's expectations are, in that circumstance, is that the client doesn't breach caps, and collectively we would have failed on that test in that example that I've quoted.
And the other one is if you don't get your form right, you're screwed. Because you can only vary downwards, you can't vary upwards with these forms. So you put it in, well, one of the big ones we're having right now is if you cancel a policy where you've paid via contribution and you don't fill out the form prior to cancellation, the client won't get a tax deduction because they're not a member of the fund when the notification comes in. So clients get very unhappy with that scenario. So think about that one. And also, you know, clients get very excited with tax returns as well. So they want to get their tax return in as quickly as possible when the end of the year comes. If you don't do the NOI before that tax return is done, again, your client loses their tax deduction. So there are risks that you need to be aware of to build into your own processes, but it's still, you know, great advice, good outcomes for clients.
Thank you.
Any more questions? Lovely. Thank you so much, Scott and David, for some good tips and traps for insurance.
Thank you very much.